Are you a startup founder looking to raise funds from angel investors and venture capitalists? If so, you need to understand how to manage and prepare your cap table for investor review. If you invest in the stock market, you know the importance of a company's quarterly financial statements. If the company delivers a strong quarter as reflected in the income statement, balance sheet, and cash flow statement, investors are happy and your stock price will usually go up. The same is true with a startup. Except in addition to these basic financial statements, startups also need to show a strong cap table, which is the authoritative ledger of all the current and pending shareholders in the startup. Most founders think they can simply track this in a spreadsheet, and they would be wrong. In this replay of a live webinar on best practices with founder equity and cap tables, we'll show you the true complexity behind cap tables, how simple spreadsheets are insufficient to manage this complexity, and how using cap table software can help founders in their fundraising due diligence. As a bonus, we'll also have a live demonstration of the cap table software solution from Aquesta. Let's dive in. Good morning, good afternoon, and good evening, everybody. My name is Sam Wong, and we're here to talk about best practices with founder equity and cap tables. Very glad to have everybody. We have a full agenda planned with this topic. So what we really want to try to do is help people to understand many mistakes that founders can make, because founder equity is a lot more complex than I think people realize. And we're here with Aquesta, one of our partners. We've got Tomas Millar and Colin McRae to introduce themselves. Tomas, Colin, can you introduce yourselves real quick?
Thank you, Sam. Hello, everybody. Tomas Millar here, founder of Aquesta. I launched Aquesta 4 years ago. Our mission is very simple. We would like to get rid of spreadsheet. Spreadsheet is inefficient, and build cap tables, and they're mostly wrong. So we have 15,000 clients on our platform, $50 billion asset under administration. Besides cap table, we offer different type of valuations, mostly 409A. We have in-house NACD certified team. We can get you also different valuation, mostly asset valuation, equity. So why you should care about Aquesta? We have amazing UX UI. We are 70% cheaper than our competitors. You can build a cap table within 2-5 minutes. So we are SaaS first. We don't upsell any different services. You sign up. We don't share data. We are super private, and most importantly, we are careful with our fundraise. So obviously, we don't get into spiral of different rounds, and that makes us very sustainable. Our Q1 was profitable, so you can also reach out to me on that part, how we practically built a profitable SaaS company with limited funding. I actually shared my email in the comments. It's tom@aquesta.com, and yeah, please sign up for Aquesta. Sam, the floor is yours.
Yeah, thank you. And you guys will hear a lot about the entire issue of cap table management, cap table problems, etc. And hopefully it will be very informative. Colin, do you want to give yourself a quick introduction as well?
Sure, yep. I'm Colin. I'm a partner at Aquesta. Been also here from the beginning, and I lead the evaluation team over here as well. So, yeah, we provide 409A evaluations as well as cap tables. So we're quite hands-on. So if you reply, we'll usually get back to you within 24 hours. So just, yeah, if you have any questions, you can let me know how to.
Fantastic. So I mentioned earlier, my name's Sam Wong. For those of you who don't know me, I run a company called Fundable Startups. Our mantra is 90 days to fundability, and our specialty is execution. We want to help people to execute well so they can build a great startup. My background, I've been a 5-time startup entrepreneur, a CEO 1 time, a CTO once, and a technical VP 3 times. I serve as a coach and instructor. I've been fortunate enough to go through 4 acquisitions where I've been an employee, plus 2 more where I was an advisor. I wrote a book on startup execution, and I build a lot of startup training classes, which includes a lot of resources and content. I'm an engineer. I'm not a fan of high-level platitudes, so I have very visual training content, resources, templates. I basically am trying to build the same content that I wish I had when I was a first-time CEO and made all sorts of mistakes. So hopefully my hindsight becomes your 2020 insight. So we also do custom projects, including startup validation, which is lean startup idea validation. We'll help build pitch decks, and we also do a lot of custom coaching. This topic is a topic I delivered last year at TechCrunch Disrupt. If you're familiar with the startup space, TechCrunch is the premier startup conference in the world. Probably Startup Grind, in my opinion, is #2, but TechCrunch Disrupt has the largest audience, has the most famous people who show up, and I got to share a small stage with some of the industry celebrities. Okay. In this session, we are going to talk about common startup equity mistakes. Then we'll talk a little bit about equity distribution strategy as you as a founder. How do you distribute equity? How do you share it? Okay. Then we'll get into capitalization tables, or cap tables for short. What they are, why you want to get them a certain way, and how to be able to build them. Then we'll talk about an interesting concept which almost never comes up in the startup space, which is fully diluted shares. It's a very important concept to understand when you're managing your cap table. Then we introduce a concept called cap table debt. As an engineer, there's a concept called technical debt, and there's a very similar analogy with cap tables. Okay. Then we'll use another analogy to describe how important it is to manage your cap table the right way. Cap table management is an active thing that you do. Okay, maybe not every minute of every day, but it is something that you do actively, just like driving a car. Okay, so then we'll touch bases on cap tables and fundraising and how that affects the fundraising process. We'll get into an Aquesta live demo. I love live demos. Okay, because then you get to see all the features and functionality of the platform and product and how it works, and we'll wrap up with a summary. In that summary, you'll also have an opportunity to get some discounts, so stay here till the end. All right. A lot of people don't like details. And as a perfectionist and as an engineer, details matter. Okay, if your startup is this truck and you're driving down the road, there may be a small pile of nails. Compared to the size of the truck and the weight of the truck, the nails are inconsequential. But if you hit the nails the wrong way, the best that you can hope for is maybe a flat tire. The worst result is a crash. And if that crash is bad enough, that truck may no longer be drivable. That is a very relevant analogy to just operating and driving your own startup. You need to pay attention to where the potholes are in the road. They may be small, they may be big. You need to pay attention to the obstacles in the road. Some of them can completely curtail your startup. Before we get into the details, we do have to do a disclaimer. This session does not constitute legal, tax, or financial advice. You should contact and work with a qualified professional who knows your specific situation. Okay. We will be using the Q&A window, the chat window for questions and answers. So please pop your questions there. Okay. And with that, we're going to dive into common startup equity mistakes, as well as one way to be able to distribute, to solve some of them. Okay. The first and most common mistake that I see is an unfair equity split. And that's a situation where, for whatever reason, you have maybe a team of 3 co-founders, and somehow, some way, one of the co-founders realizes they agreed to a situation that really isn't fair compared to the level of contribution that the other founders make. So that usually results in some type of latent issues that don't become visible for some period of time. Okay. Those are very, very challenging situations. Another challenging mistake is no stock purchase agreements from the founders. Okay. A lot of founders just do a handshake and say, well, okay, you take this percentage, I'll take this percentage, and you're off to the races. Well, The right way to do things is to actually put together a stock purchase agreement. And the right way for founders to receive their stock is not just with a handshake. A handshake doesn't mean that you actually have stock. You should put together a stock purchase agreement, and it should have several pages worth of legal terms and conditions that a startup attorney will help set up for you. They are fairly templated. It doesn't have to cost a lot. But it is the right way to do things because those terms and conditions will protect you and your co-founders in corner case situations, which have come up many times with other startups. We've also seen situations where founders don't put vesting on their own co-founder stock, including yourself as the main founder, if that's you. Every founder should have vesting tied to their stock. And you may say, well, I don't want vesting. I'm the founder. I quit my job to be able to get into this startup. I'm sacrificing a lot. And yes, that's correct. But you should still have some vesting tied to it. And we'll talk about why later. There's also a mistake where founders fail to file an 83B election. In most cases, as a founder, if you get your stock early on with the life of the company, you should elect to be taxed on that at the day that the stock rights are transferred to you. Okay. If you don't do that, then it can cost you several $100,000 of tax implication, higher tax bill if your startup is successful. You make this election with an 83B filing. You have 30 days to do it after you receive your stock. So it's the clock is ticking. Lots of founders don't know about this. They haven't made that 83B election. It is very painful and costly to undo this and fix a missed 83B election. In some cases, it can't be fixed. There's also challenges with 409A compliance. 409A refers to a section of the IRS Internal Revenue Code, and it's about effectively proper valuation of the deferred equity that you are receiving. Colin had mentioned that he leads a valuation team. Many cap table vendors will also help you with, well, not just cap table vendors, lots of vendors will help you to do a valuation of your company. And you should do this to protect yourself from potential tax burdens later down the road. Okay. We can talk about that a little bit more if you're interested and if we have time, but there's lots of detail about that. Okay. There's also a mistake where we see founders just saying, "Well, we're all in. We're going to start paying for startup bills using our credit card," or they just write a check of $5,000, $10,000 to help bootstrap the company, and there's no legal documentation on that. And what ends up happening is the founder basically loses the value of that investment from an equity perspective. That's a mistake as well. Okay. We've also seen founders who do not understand how to be able to run their founder equity, get initial funds maybe from a friend or a family member, and they don't have the right type of agreement, and that agreement sets the wrong expectation with the incoming investor, and it ends up being a burden that's very, very heavy for the founder to carry, just like the guy trying to carry the car. Okay. And then, as I mentioned before, we've seen many situations where there's a handshake agreement, and then later down the road, people have a misinterpretation. Wait a minute. I interpret this to be 6. No, 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 no. I meant 9 on that. And you both have your own perspectives on what's going on. When you don't write it down, the lack of contrast can cause a good number of problems. We don't have time to explain all the details of many of these problems. We're only going to focus on one of them. The detail of these problems and why they're important is covered in our pro and premium training packages on our website, fundablestartups.com. Okay. So let's talk about founder equity and splitting founder equity. The ultimate issue is when you're first getting started and trying to launch your startup, you only have a certain amount of pie, so to speak, or a pizza pie, as these guys are trying to split the number of slices that people get. How do you do it? Well, first off, you should establish the goal. I think most people would agree that the goal should be fairness. And unless you've worked with your co-founders for many, many, many years, sometimes it's not always clear what each person brings to the table. One party may say, I can, I'm a great athlete. I can long jump 20 feet. Okay. And you start working together and it looks like you got to jump over this, pit here and it's 18 feet and you can only jump 12 feet. So you're falling down into the pit every single time. So just because somebody says that they can do certain things doesn't mean that that's exactly what they do. But ultimately, you want some way to be able to distribute the equity fairly. Okay. If you don't find a way to distribute it fairly, what will usually happen is seeds of resentment will come up. And you may think that, well, no one's talked about it, but those seeds are there. And you may also think that, well, our startup's doing really, really well. Everybody's slice of the pie is growing, and the pie is growing. Therefore, their slice of the pie is effectively the amount of pie that they have is growing. Okay. Why is anybody getting unhappy? Well, the reality is, if their startup isn't doing well and it's starting to struggle and might shut down, no one's going to argue about how much equity they got because effectively everybody's equity is going to probably go down to zero value. What happens is when the startup is successful, that's when disputes come up because now you're starting to potentially argue about real value and some large amounts of money potentially. So this resentment is something that you really want to be able to address and be aware of, and hopefully get it right from the beginning. Most people use a static approach to splitting equity. And what that means is that I'm the CEO. It was my idea. I'm putting in the most, et cetera, into the company. Therefore, I'm going to get 50, 60, 70% of the equity, et cetera. And then this other co-founder over here, they're important and stuff. So that person's going to get 20%. And then the third co-founder is going to get 10%. So I get 70, somebody gets 20, somebody else gets 10. And you guess. And let's say the person who gets 10% is a rock star in the making and actually delivers more value than the guy or the gal who gets 20%. If you split the equity statically, you don't have an easy way to change that. Okay. But that's the most common way that people split equity is a static allocation. You can do it dynamically through a system called slicing pie. It's not very common, but there is a system developed by Mike Moyer, who wrote a book documenting it. And it's a way to be able to track how much time people put in and effectively measure how much value they do. And based on this system, people who deliver more value earn more slices of the pie, so to speak, in a dynamic system. You can also have a milestone-based equity split process where just like when somebody delivers pizza to your house, that's when the payment is made, where transfer payment or something along those lines, or maybe you actually pay earlier, but you settle it right there. Okay. Ultimately, when something deliverable is made, that's when someone potentially gets an extra bump in their stock or something like that. Or you could do some type of hybrid where you have some type of mixture and you blend in together the multiple systems. We are going to talk briefly about the slicing pie in the sense that Mike Moyer, the author of the system, the creator of the system, is a friend of mine, and basically he said that he's willing to, with his latest book, will work for Pi. He's got a giveaway when I offered to just include that here. If you're interested in a signed autographed copy from the author, you can click on this link that I have in the chat window. Okay. Or if you're fast with your phone, bring out your phone and scan the QR code, but clicking on the link is probably faster. Okay. So that will give you an opportunity to sign up for a free copy autographed by the author of the book, Will Work for Pi. It's a very interesting system on how to be able to track the contributions of a specific employee, not just founders, but all employees can use the system so that what you contribute is proportional to the equity that you receive. Okay. So let's talk a little bit about cap tables. Okay. What is a cap table? It is the authoritative ledger that shows the exact ownership of all company shareholders. Okay. You can do it on paper, like this old style ledger that we're showing here. But almost nobody does it on paper. Everybody does it electronically. Most people still use a spreadsheet. And that's coming from myself. I'm an Excel power user. If you've seen some of the spreadsheets that I build, they're nasty. I built 50,000 cell spreadsheets that sometimes takes 1 to 2 seconds to recalculate. All right. I love spreadsheets. And as a spreadsheet lover, I'm here to tell you it's tough. The end of the spoiler is don't use a spreadsheet, and we'll talk about why in a second. Using an analogy, okay. We'll talk a little bit about accounting software, okay? And hopefully you all understand the need to be able to do accounting. In the 1930s, there was no accounting software, there were no computers. People used a big fat book like this to be able to track, all the details of finances in the company. Well, let's talk about how to track a transaction in your company. Well, let's say you just started your company a little while ago, you funded it with some bootstrap funds, and now you're buying laptops for the founders. Okay, very reasonable thing to do. So you bought a laptop, it's a company laptop. How do you account for that laptop purchase? Well, it's an Apple MacBook, and Macs are a little expensive, so it's 2,400 bucks for this laptop. The simple approach that most people take is, okay, 2,400 bucks. That's an expense. I spent $2,400. That means my bank account is $2,400 lower. My expenses go up. Assets, I'm not really tracking that. I just know that it belongs to the company. And because you incurred an expense, the assumption is that you have $2,400 less income during the month that you booked this transaction. Most people say, okay, I got that. That's pretty simple and clear. And that would be wrong. Okay. This is the wrong way to book this transaction. The correct approach, following generally accepted accounting principles, GAAP for short, okay, is this. You still have the same $2,400 purchase. The expense in the first month, let's say I bought it January 1st, and that at the end of the month, the expense is actually $40. Okay, what? Where'd you get $40? Well, that's the monthly depreciation based on simple 5-year straight line depreciation. So $2,400 divided by 60 months, okay, 5 years, would be $40 per month. All right. Well, why did you pick 5 years? Because that's what the IRS defines. If you're in the United States, that's what the taxing authority defines as the useful lifespan of a laptop computer. Okay. So you're supposed to depreciate it over the useful life of 60 months, $40 a month. Your bank account, of course, went down 2,400 bucks because you had to pay for the laptop. You have an asset on your books that starts off at a $2,400 value, but since you've already had 1 month of depreciation, your books show you have a company asset worth $2,360. Your income for that month that you bought the laptop goes down by $40. It does not go down by $2,400. Okay. So you see a significant difference here, a 2,300, almost 20, over $2,300 difference in the income already. And this is just basic accounting. Then there's another concept, income from operations. If you have an accounting background, you probably refer to this as EBITDA. Okay, income before income, excuse me, earnings before income tax, depreciation, and amortization, EBITDA. All right. Taking the simple approach, what is your EBITDA? Oh, okay. But the correct approach with GAAP accounting, your income from operations is zero. Because this transaction of buying a laptop is not the business that you're in. The income from operations is what you want to reflect as the profitability of the company. Okay. And that's what you want to be able to present. When you take the simple approach, you have problems. The management accuracy of your accounting is wrong. The tax reporting is wrong. Once you file your end of year tax return based on the financial statements, you're going to actually be making false statements to the IRS because you did not comply with proper depreciation. We're not getting into advanced depreciation concepts like MACRS, okay? We're just doing simple straight line depreciation. In addition, many times that you want to maybe go to a bank and get a loan or a creditor, they will ask for your company's financial statements. Okay. Your financial statements about your income and your assets, that's wrong using the simple approach. The investors will also ask for your financial statements. By taking the simple approach, your company appears weaker financially. Okay. So this is basic accounting. And it's worse if you wait. I talk in my class on how to build startup financial models, and that's where we talk about startup financial operations and stuff. It's worse if you wait. You don't want to just compile this pile of receipts. You need to implement QuickBooks. I don't know a single business consultant in the world who would suggest trying to do this manually through the paper and pencil method or through the pile of receipts. No one recommends that. Everybody says use QuickBooks, use Xero, use FreshBooks. I don't care what software you use. Don't use a paper ledger, and certainly don't try to run your accounting on a spreadsheet. Okay. It's not that expensive to use QuickBooks, like as low as $25 a month or something. Okay. The goal of accounting software is accuracy. Is the information correct? Completeness. Do you have all transactions included, or are you leaking transactions somewhere? Is it clear and easy to understand? Your accounting software generates periodic financial statements. Those financial statements help you as a leader of your organization make management decisions. Can you quickly and simply look at those financial statements and immediately know, oh, we're not doing as well as we thought. We need to actually do something to address these problems that we have. The accounting software should also be standards compliant. We talked about GAAP, generally accepted accounting principles. Are you doing your books the accepted way, or are you driving on the wrong side of the road? Well, you may think, nothing wrong with that. I'm making progress. I'm driving down the road until you see another car about to hit you head on. Okay. And is the data reliable? Will the infrastructure that you're putting into place, the ropes that you put into the side of the mountain, will that help you grow, build, or climb the mountain, so to speak? These are the goals of accounting software, and cap table software has the exact same goals. They're like identical twins trying to do the same type of thing. You have the accounting software on your left and your cap table software on your right. Okay. So capitalization or cap tables. We already mentioned and defined it as the authoritative ledger that shows ownership of all company shareholders. And it should include all elements such as preferred stock, common stock, stock options, convertible securities, warrants, etc. It needs to be accurate in spite of the complexity. It needs to have all the shareholders. It should be clear and easy to understand. If you do it in a spreadsheet, and again, remember, I'm a spreadsheet junkie. I've gotten startup founders giving me spreadsheets, and in many cases, I have to take 20 minutes to figure out, okay, this formula is tied to that cell, and stuff. Most people who build a cap table spreadsheet cap table in a spreadsheet don't make it clear. You have to have an analyst like me or somebody look into say, what is the formula here? Is the formula correct? It's can be complex. It needs to be detailed where you capture the number of shares, the share class, the percentage ownership, the grant date, board approval date, vesting cycles, etc. It's not just Joe is the CTO and Joe has 20%, which is 2,000 shares or whatever number of shares. It's not as simple as that because in most cases, I almost never see a cap table spreadsheet that builds investing. And that's simple to do, but almost nobody does it. It also needs to capture fully diluted shares, and we'll talk about that. If you have signed a safe agreement, okay, with an investor, that needs to be captured. But how many shares did that person get? We don't know because a safe doesn't define a fixed number of shares typically. Okay, so it gets really hairy very fast. Let's look at a simple cap table. You start with 4 founders, Ashish, Bella, Christy, and Diego. They agree to start the company, and this is what they agreed to the ownership percentages to be. And this is way oversimplified, okay? And then let's say the company's doing well and they're planning to hire employees. The next thing to do is to create a stock option pool. For a traditional startup, you should create a pool of options where you will dispense share grants, option grants, to people that you hire as employees. So let's say this company is doing well, they're going to hire these 7 employees over the next, 6 months, etc. So these are the names of the employees: Emily, Fred, Gary, Hunsu, Isabella, Jose, and Kumar. When those people are hired and they get the job offer letter, that job offer letter will include an equity compensation promise, basically, that you're going to get a certain number of shares. Those shares, or really options, are granted from the pool that you created in the center column. Unfortunately, most cap tables are wrong because they're built in spreadsheets. That very rare that a spreadsheet even has this level of detail. And again, we're at kindergarten level cap tables. Cap tables go up to college level complexity. Okay. Cap tables tend to be wrong and they tattle on you. Okay. If you have any dirty laundry in the how you built your cap table, it will become apparent that, okay, back in the day when you used to hang out your laundry to dry on the clotheslines and stuff, people would say, "Oh my God, that guy's underwear is yellow." Okay. It's gross. And people are going to have the same reaction when they see a dirty cap table if that's your situation. You don't want that. So let's talk about standard 4-year vesting. This is Bella. She's the CTO. You've granted her 1,200 shares at a certain options, the right to purchase 1,200 shares, which is a stock option, at 25 cents per share. So most people, I think, understand this, but I'll cover this briefly here anyway. But standard 4-year vesting cycle would mean Bella doesn't get any of those options on day one, the day that she hired. She has to vest over time. You have to stay at the company for a period of time before those options slowly or incrementally yours to keep. So in the first year, 0 options have vested. It's not until the employee has worked 1 year, typically, is the 1-year cliff, where suddenly the first 25% of the options get vested. If 1,200 options were what was granted, then 300, 25%, are now vested. After that first year, on a monthly basis thereafter, you have incremental vesting until you get to, say, year 2, at which point you will now be 2 years into a 4-year vesting cycle, and 50% of those options granted will vest. And you do the same monthly vest up until year 3, which 900 options will be vested at that point. And then at year 4, monthly stair step up until all 1,200 options have vested. That's the standard 4-year vesting cycle. Most startup cap tables don't even cover vesting in spreadsheets, that is. Okay. And the reason you need a cap table platform is because the amount of data you need to track is a lot more complex than just the vesting and number of shares, etc. This is the actual export. I have actually implemented cap table software before, and when you import it into the cap table platform, there's a lot of administrative data that you have to have. There's some equity metadata about the type of stock option plans that you're granting from, okay, that you need to be able to define. And then there's lots of data that you have to capture on the equity grant itself. Okay, this is the actual onboarding data for Carta. Okay. There are more than 200 total data elements to consider. Not all of them are required, but many of them are. Okay. If you do multiple stock grants, okay, let's say you've done 5 stock grants, option grants, you're already into the thousands of data elements. Do you have thousands of cells capturing all of your cap table in your spreadsheet? Probably not. Okay. Cap table software enforce a certain level of discipline to capture the right data that you need. Okay. It is absolutely key to use a third-party cap table solution, Aquista being one that you'll see later in this session. Okay. Let's talk about fully diluted shares. Okay. Most startup founders have no idea what this means, and that's a problem. Okay. But since you're here, you're going to be more educated than 98% of the startup founders out there. Fully diluted shares helps you understand exactly how much equity of the company you really own. Okay. So most people are like, that's not hard. You just take the number of shares I have and the total number of shares in the company, and you do simple elementary school math. So if I have 30 shares and the total number of shares in the company is 120, I own 25% of the company. Why is this hard? Well, you're about to see. So fully diluted shares. How many total shares are there in the startup? Okay. There's the concept of authorized shares. The number of shares authorized in the startup is defined in the articles of incorporation with a startup typically. And for a well-formed startup, but if you created your startup corporation the right way with the help of a startup attorney, the seasoned startup attorney probably made the authorized shares somewhere in the 10 to 20 million range. I prefer 20 million. Okay. If you have if you're planning on doing a startup and the authorized shares that you've created in your C corporation is not at least several million, you made a mistake. If an attorney helped you to do that, you immediately know that attorney doesn't know startup space. Okay. You might consider finding a better attorney who actually does know the startup space. Okay. Separate issue. Then you have the concept of issued or outstanding shares, and then the concept of not yet issued shares. All right, what does that all mean? That gets a little confusing. In the area of issued shares, you have common and preferred stock. Okay, just two major classes of stock, common and preferred. Then you have a stock option pool. Remember, we said earlier that Bella is the CTO, and she has the right to buy 1,200 shares at 25 cents a share. So Bella's stock rights would fall into that dark pink option pool portion of this diagram. Remember, we had vesting, the 4-year vesting cycle with the 1-year cliff. So that means some shares are going to fall into the vested category if Bill has been there a while, and some shares will fall into the not yet vested. And that includes common and preferred stock. The common stock could be subject to vesting as well. That in fact, if you are a founder, it should be subject to vesting, which is really documented in the stock purchase agreement, which you should have signed when you got your stock. Okay, it's the repurchase right, which is very similar to vesting. So that would also apply to the founder stock. All right. So that is the definition of the common and preferred stock and the stock option pool. The the union of the issued and outstanding shares, as well as the not yet issued, is the number of shares that have been created. Okay, the not yet issued. Remember, we talked about creating a stock option pool. You fund the pool with a certain number of shares, but it may be that's no employee has been hired yet to receive all of the shares. That's why you have some not yet issued shares. If you have some shares that are created, that suggests there are some shares that are not yet created. Okay. And these shares would be obligated to people, but not yet created in certain situations like signing a convertible instrument. A safe and a convertible note are the most common. If you have not yet converted a safe or a convertible note into equity, the obligation that you have would be in the not yet created box, the dark green here. This would also include warrants, which are not as common, but if you've done certain transactions, the other party might have asked for warrants, which is basically like a stock option in the future kind of thing. Okay. Warrants, if somebody exercises their warrant rights, then you have to create new shares when that party exercises that right, which is why it's not yet created today. Then there might be some other miscellaneous unfulfilled stock obligations. The combination of created and not yet created represents your fully diluted shares. The fully diluted shares is the total number of shares that would exist if all parties exercise their stock rights or fulfilled their stock obligations. The fully diluted shares, it's what goes into the denominator of this simple grade school formula. Yes, the grade school formula is simple, but the denominator is complex. All right. So fully diluted shares goes down in the bottom. With this funky Venn diagram that I have here, with all the shares that go through the vesting. Remember, you have the 1 year cliff, the 2 year monthly vesting, and then, third year, fourth year, all the shares that gradually vest. How many cap table spreadsheets do you think take into account not just the vesting, but the stock option pool, the granted, the non-granted, the complex math and a safe conversion in the future? Okay. Almost none. I have never seen a spreadsheet that did it all. I tried to build a spreadsheet to do it all. And after spending about 26, 28 hours doing it, I'm like, why am I doing this? Okay. There are free products out there that will do it for you. Okay. And so you get the idea. This is a lot more complex than meets the eye at first glance, which is why the concept of cap table debt is important to touch upon. If you are a technologist, the concept of technical debt hopefully is clear to you. Technical debt is where, for the purpose of speed or, whatever, you might take a shortcut. Instead of doing something the right way, you're going to just take a shortcut and just do it this way. I know I'll have to fix it later, but you do it intentionally for the sake of time. Cap tables have the same type of problem. You can incur cap table debt, where at some point you will need to fix it and clean it up because debts need to be repaid, so to speak. If you don't do it, you're likely to have incorrect cap tables. Henry Ward's CEO Carta is pretty famous and stuff. It's a little Carta's had some ups and downs lately, which if you just do a Google search on the news, you'll see some of that. Henry said most cap tables are wrong. It's not my opinion. He's the CEO of the biggest cap table platform out there. Okay. There is an actual situation where Tibco, company that I actually use to integrate and sell, all right, middleware software, they got acquired for $4.3 billion. But there was a cap table problem. And that cap table mistake resulted in $100 million error. That $4.3 billion acquisition turned into a $4.2 billion acquisition. $100 million was, unable to be realized, which resulted in a big fat lawsuit. Okay. You can look for shares through the spreadsheet, but if you're not doing right, I don't care what type of Jedi mind trick, it ain't gonna work. Okay. Jabba the Hutt is not susceptible to the mind trick. Okay. The spreadsheet is not the truth. Most cap table spreadsheets look something like this. And we've already talked about the stock information that you have to capture. See all those little bullets? I didn't even put all the bullets that you need to capture. Okay. Whenever you do a stock grant, you need to capture stuff like this. So if you have multiple founders, the documents are the single source of truth. And every time you do a grant to a founder, to a new employee, to an advisor, you're going to have this grant document with all that stock information that you have to capture. You're going to have many, many documents. If you don't capture all the data points on all these documents the right way, you're building up bigger and bigger cap table debt. Okay. So just like software has the bugs that you don't fix adds up to technical debt that constrain what you can do. Cap table debt is very similar. Your equity is going to be nebulous, confusing, etc., and it's going to slow you down. I've seen companies not be able to issue a job offer because they had cap table debt problems. I've seen companies who actually lost a funding round because they had cap table debt problems that were not able to get cleaned up. Common problems are here. I'm not going to read all of them, okay? But I've got 13 different problems that I've seen that results in building up your cap table debt. Many cap tables are a mess. Cleaning up later can cost $10,000 to over $100,000 if it can even be cleaned. In some cases, the city would just come in and condemn this house and say, no, you're tearing that down. Okay. It's a mess because there's the concept of doing things the right way, the fastest way. And I'm going to use an illustration called a racing line to get to that point. What is a racing line? It's basically if you're a, Formula One driver, et cetera, a race car driver, it's the fastest way to go around the track. Okay. And to illustrate, if you had a hairpin turn here, there'd be 4 different points of the navigating the turn. You have the braking point, the turning point, the apex at the peak of the turn, and then the exit point. So the car going down this hairpin turn would go at a certain speed, start to brake, then coast a little bit through the turn and accelerate out of the turn. All right. And so those are the areas that are relevant for creating a racing line, which if you looked at a physical racetrack, you see the tire marks on the road. All right. And I used my hand to freehand draw what the racing line might look like. The green line, if you drove down that, hypothetically, green line, if you drove down that green line, it'd be the fastest way to navigate this turn. Well, you might not hit that green line. You can still navigate the turn, but you're going to go slower. And there might be other pathways that are not perfect. It's going to be a little bit slower. Then you might actually have a problematic path where you're like, okay, your tires came off the track a little bit, but you lost a lot of time, but you're still in the race. And then there's a disaster situation where you get off the track so badly, you hit the wall and you crash, you're out of the race. In the same way that a well-used racetrack has racing lines, which you can kind of see if you look closely at this, all the hairpin turns and all the corners and stuff, you see the tire tracks where everybody goes down that path. Cap tables have the same concept of this is the center path that you want to stick to if you want to do it the right way. So when you create your startup, you generate the grants to the founders, etc. The ideal path might be the dotted line down the middle. And not everybody's perfect. Not every startup's going to take the perfect ideal path. So you might have this little funnel of, okay, as long as you're in that funnel, you're going to be okay. Okay. Then you create the option pool, as we talked about earlier. But let's say when you started with the founder grants, you're not in the center of the dotted line. You're already at the far edge. So when you create the option pool, you have another racing line. You have another one of that V-shaped thing where, okay, as you could do something in that range. But let's say you didn't know how to manage your cap table well, and now you're already at the far edge. Again, once you start getting investors and you're at the far edge of that extra funnel, you have the racing line from there again. And it's theoretically possible that you've already lost, you've got this big gap between where you're at the very, very top, the worst case scenario, and the ideal at the dotted line down the center. So the green is where you want to be. The yellow is where, okay, if you're there, it's not as good, but at least you're not going to crash. And then the red, you might actually find yourself in a very difficult situation. I'm going to skip this slide on cap table progression because I want to leave some time at the end. I'm going to skip this about funding after multiple rounds in terms of how the slices of the pie grow and how the pie itself grows. Okay. Cap tables and fundraising. Okay. There's a 5-step life cycle towards raising funds. You introduce yourself to an investor. If they're interested, they might invite you to a private meeting where you do a detailed pitch. If you do really well, then they're going to say, let's start doing due diligence in the company. I want to know more about your company. Then you start negotiating the definitive agreements through a term sheet. And then if everything goes well with the definitive agreements, they'll wire you funds. I want to focus on that 3rd step, verify, due diligence. Due diligence is a process where a third party looks at all the details of your company to assess the risk. This is a due diligence checklist with 202 items on it. Not every investor will ask for 202 items, but every investor, professional investor, will ask for due diligence. Okay, the due diligence that they'll ask for would be financial data, legal data, and human resources, people data. It might include budgets, actual past investments, financial statements, tax returns. On the legal side, all of the formation documents, the contracts that you've signed, regulatory filings, making sure you're government compliance, and all that will go into a data room. On the HR side, you'll probably have their understanding what everybody has in terms of their ownership of the cap table, the founder agreements, separation agreements, etc. You have for financial statements, which should come from QuickBooks, and you also have your cap table, which should come from your cap table software. These are two major deliverables in due diligence for funding. I have seen one or both of these completely blow up a fundraising deal. Okay. You want to get that done the right way because you don't want to build an uninvestable cap table. I've got here 4 different versions of uninvestable cap tables. What that means is you have misled your company far enough that a professional investor will not invest in you even if they wanted to, because the cap table is going to screw up their ability to make money. All right. So let's now get into a demo. All right. Colin, because I went a little bit long, I'm going to ask if you could kind of trim the demo a little bit shorter. I'll stop sharing, and Colin, go ahead and um, share your screen for a demo.
Thank you, everybody. Yeah, as I said before, I'm Colin. I'm a partner at the firm. I've been here since the beginning, so I work mainly with the valuation team, but also with the cap table team. And as our founder Thomas said in the beginning, we have around 15,000 companies on our platform. So as you can see, and as I'll show you in the demo, we try to make the UI and UX really clean and simple to understand. You don't need a manual to do it, to kind of issue stock and track everything. And it's, we try to make it like 1 or 2 clicks to kind of do everything. So for example, here's a, a sample company that we have on the platform. But let's just say you just started and you want to make a new company. You can go up here and you can add a new company. And it literally takes probably 30 seconds to get on board in the system, and it's completely free. So for example, here, if you type in your name into the system, if you're a C Corp, let's just say you incorporated this year, and you're using, you're based in the US. Let's just say that you issue 20 million shares, par value as, you know, as usual. And then let's just say that you're the founder and you're already in the system. Now I'm going to be issuing, let's just say 1 million to myself. And a lot of this will pre-populate with what you said before. When you click complete, it's 3 steps and you're literally into the system right away. And you're good to go. So you can start using it right away. This is our free version. So we have actually, for most of the stuff, for issuing stock, for tracking things, it's actually completely free up to 20 shareholders. But there are some features which are currently within our paid program. So I'll go back to the one which has everything just to show you kind of about the system. So like I said, yeah, we try to make the UX UI really clean so you can kind of get where you're going with 1 click. So for example, here's a dashboard with a summary of all of the different share classes, an ESOP, the common stock, the seed, and a Series A. And if I go here, if I click on summary, I can go directly to the page where it has a summary of all the different equity classes. So you can see here that there's issued shares, how much capital, and how much ownership is in each. So for this company, they had a few round of fundings. They also have some safes as well. And let's just say I clicked on the option pool. So I'll just have 1 click and go directly to the option pool. You can see all of the grants in the system and who owns what. If you do have many option holders, you can navigate from at the bottom. You can also filter by different share names or grant names. And let's just say I want to go into this grant option with Peter. So I can click here and I can see exactly what the grant is in the system. All of the details, there's 100,000 options, how many invested, and at the bottom you can see the vesting schedule. And also the shareholder would see this as well. So we have standard templates of vesting schedules, 3 years, 4 years with a 1 year cliff. So you don't have to make it all in Excel. You can actually just, populate it once you save it and connect it with the certain grant. It just all kind of calculates by itself. As you can see on the sidebar, yeah, you can track common stock options, warrants, and safes or convertible notes. If you are still using spreadsheet and you have, all of your data there, we also have a spreadsheet view in the cap table. So you can actually, if you have all the details of your shareholders, your option grants, your common stock, and let's just say you might have, 100 or let's just say 1,000 option grants, you can actually just copy paste it into the platform and click save. It will populate. You don't have to do it one by one. This saves some of our companies hours and hours of time to do the admin work. So it's really easy to kind of go in and out of spreadsheet if you're more comfortable with that, in the beginning. We also have a document Dropbox. So it's kind of like a data room where you can upload documents, you can share it with shareholders. Like for this one with Dane, this is his safe agreement. So I can click Dane here, I can share it with him. And then once he goes into his own shareholder account, he'll have access to that immediately. So right now we actually don't offer a size limit. So some of our companies, they use a lot of data. So that's fine, you can use it as much as you want. Um, We also have modeling here. So if you are contemplating a round modeling, another funding round, and then you want to see how much dilution will occur with the new investors, with the current investors as well. You can set the pre-money valuation. You can, see how much the option pool you want to top up, how much the investment amount is. So let's just say here, this company's a Series A. So let's just say the Series B is 50 million pre-money. Let's just say the new investor is going to be investing 10 million and you want to top up 5%. You can go down here and see, okay, so the founders own around 31, 32% of the company now. And right after the funding, they would be diluted this much. The safes would automatically convert, to this much percentage here. The new top up options and the investors have this much as ownership. You can do it by class as well as we can do it by shareholders. So yeah, this is a little bit more difficult to do in Excel. So you can do this. It's all connected. So it's pretty fast as well. We also have a reporting section, so you can download all this data back into Excel, and you can save it for your record keeping as well. We also have admin records on the side. So we have board resolutions. So for example, if you want to, issue stock and you want to create a board resolution, you can actually create a resolution. You can attach a document or, put in some words here and then send it out to the people on the platform. So if you have extra approvers, you can invite however many people you have on your board to vote on the board resolution in the platform. And then you can send an email. You can even set up expiration date and you can, write the email here and then have open voting or anonymous voting. So you can do it in the platform and send it out. So it might be easier than drafting it and then sending a bunch of emails to people. We also have e-signing on the platform as well and certificates for the shares. So if you want to document it, officially, you can issue the certificates on the platform and also e-sign it too. So, and you can also save your e-signature on the platform. We also have safe agreements here for e-signing as well. And then also we have some compliance features. So currently we have Form 3921, which is if you have any option holders which are exercising, you actually have to file something to the IRS. So you can do that on the platform. Like Sam said before, we also have 83B filing as well. So you can generate that. You can sign it. And then what we do as part of Equities is we actually send it to the IRS for you if you're on our paid platform. So you don't have to send it out and find out where the nearest IRS center is. You can do that. And then ASC 718, this is a little bit more advanced feature for stock option expensing. Like the middle and higher companies do this, but for some other platforms, it could cost like $5,000 to $10,000 to do this because it's kind of an advanced feature. For ours, it's a lot cheaper and it's still accessible to all other startups. So, and we also have 498 valuation, like I said before. So if you do have the 498 valuation done by us or another provider, or if it's even determined by your board, you can upload the results here. And then usually a 498 valuation that the fair market value price, it's good for 12 months. So here it'll put it for 12 months. And you can choose if you want to share it with your shareholders or not. So if you want to say, okay, I want you guys to see how much the value is of your holdings right now, you can share, or you can say, no, I don't want to, I don't want to share that right now. So I can show you really quickly. So let's just say it's 50 cents right now. If you went to issue new options in your option pool, when you issue, let's just say issue something to her, the fair market value would show up. So it kind of shows you, okay, so you had your 409A, you should be issuing your strike price at this amount or higher. So it's kind of just a reminder that the compliance comes into play so you can kind of see, what you should be issuing at. So this is kind of a really brief version of all the features on the platform, but a lot of things are actually free. So there's up to 20 shareholders, so you can kind of take advantage of that. And my last really quick bit is on this is a shareholder view and in the platform, all of the shareholders, they all get their own separate account. So they can actually see what they own and they have a little bit different UI. So for this, Rebecca, there's a shareholder, she can see how much options she holds, how much approximately the equity value is, and also the vesting schedule here. And then you can see the next events of when, the next options will issue. And then you can also see on the side that you can track her documents. She can track if she has any tasks that she has to sign something or do something on the platform. So and one advantage is that of a system is that all of the shareholders would know and be updated of what they own. So you can really use it as an incentive to say, okay, you have value in the company and I'm updating it all the time. So you're really involved with the equity section. So this was kind of brief, but that's kind of a snapshot of all the different features that we have in the platform.
You may have noticed during the demo, there's a lot of navigation, things that you can do on the left nav bar. That's because there's a lot of functionality that you need to do to manage your cap table correctly. Again, you don't want to try to do that in a spreadsheet. Okay. In the same way that you don't want to wait with a pile of receipts, you want to implement a cap table software platform sooner rather than later. Colin already mentioned that if you're just getting started and you're still small, you're probably going to pay zero for their cap table software. And most cap table software platforms have the same type of thing where they know they want to help you in hopes that when you grow, you'll eventually grow into a paid plan. So it costs nothing to get started other than some time. And that time is what you should put in because you don't want to wait. If you wait till tomorrow, you'll get more founders, more employees, more investors. You'll sign more safes, more convertible notes, and you might make some stock sales. That gets more and more complex. You want to implement it quickly. Okay. So this is a chart I put together. The Aquista team didn't put it together, but I wanted to make it clear. One of the things that Tomas mentioned earlier, the CEO of Aquista, he said that Aquista is affordable. And I found that to be true, especially compared to other players in the space. So cost is on the vertical axis, and the number of users you need, number of people, shareholders, on the horizontal. You want to be in the lower right-hand corner. It's better to be in the lower right-hand corner on this chart. So Aquista's pricing, they start with a free plan up to 20 users. It's basic functionality, and the cost is zero. So it's down all the way down to the bottom. That's good. And then they also have a premium plan that gives increasing level of functionality. Even if you have just 5 users, if you want the extra functionality in the premium plan, you could end up paying a small dollar amount fee, which is still nice to be able to have that functionality. And then they also have an enterprise plan, okay, which gets tiered pricing at certain cutoff thresholds. The thickness of the arrow on this chart represents how much functionality you get. Enterprise gives you the most functionality. Well, you compare it to another cap table player. They have a free plan down at the bottom too. Call it bronze, okay, and that's fine. That's kind of comparable. But then their very first paid plan gets you to a certain point, but the cost grows very fast. Notice how high that gray arrow goes. And then they also have a gold plan, which the slope of that cost it grows even faster. We've seen people switch cap table providers because of cost reasons. Okay. So what I would say here, I know we're over, so I'm going to start wrapping up. You've hopefully been going through a learning process, and maybe I could pop up a poll here of how do you prefer to learn? Okay, and we'd love to be able to know. There is the classic classroom stuff, and this has kind of been classroom style. I do see in the chat window that people said, "Man, this is a lot of information. It's coming too fast." I understand. I can't change anything about how complex the world is. Okay, but you still should know it, which is why we have our pre-built classroom training. You also have another way to learn and gather information you need, and that's the more the athletic model, not the classroom model, where you work with coaches. Okay, somebody actually helps you to do it. We have both covered in our Fundability Before Fundraising Academy. It's 12 weeks worth of training where part one, 6 weeks on fundability, and part two, 6 weeks on fundraising. It's delivered in two 6-week programs, as I mentioned. And each week cover 2 hours of live instruction with about 2 hours of coaching and follow-up each week. We help founders get access to a community that we have on our website. And both programs offer pitch deck feedback and group feedback. The fundraising program, weeks 7 through 12, also allows you to pitch to about 5 investors in a real investors in a pitch demo day environment. The week 7 through 12, the Fundraising Academy would cover these topics: funding plan, funding strategy, and fundability in week 1. It's a quick summary of the first 6 weeks of the academy, as well as a little bit more detail. Then week 2 covers the investor mindset. You're selling your stock to investor. You need to understand what's important to them. You need to understand how to sell, what are their hot buttons, and we cover that in the investor mindset. We've seen lots of investors just immediately shut down a founder because they're selling the wrong value. Then we have a storytelling class. Okay, it's important to make sure that your pitch is engaging. We have a pitch slide template and de-risking. Most founders focus all their attention here. Week 4, we have lots of low-level detail on the pitch slides and de-risking. Week 5 is finding investors, and then what are you going to see if you get a term sheet, what those terms really mean. Week 6 is about pitch practice, your own wellness, and getting feedback on your pitch if you choose to participate. So anyway, that's the academy, and it is available on our website. The Fundraising Academy Part 2, we charge $2,500. It's literally half the price of another academy out there. All right. We're not here to try to get rich off of these. We want to help people, but we do need to be able to run the business. Okay. As I mentioned, the Fundraising Academy allows you to pitch to around 5 angel investors and or VCs. We do offer a $500 course completion rebate off of this $2,500 price tag, where if you attend all 6 weeks and do the 5 homework assignments, you get $500 back at the end of the course. So it's really a net $2,000 cost for 22 hours worth of training and coaching, which we've tried to make it very approachable and a bargain. In fact, if you, because you're here, we also will knock off another $200 discount. So total discount would be about $700 if you include the course completion rebate. If you're interested, you can scan this QR code, or let me go ahead and paste this shortened link into the chat window. And there is a question here while we're going through this. Tomas and Colin, does Acquista support non-US based founders or startups?
Yes, yes, we do. We do, of course, we do. Yeah. As far as
Okay.
the company has shares or units in case of any type of LLC, then yes, we do. Currencies, you can also set up currencies. So we do.
Okay, sounds good. All right. And by the way, if you are interested, that $200 discount for our academy, you got about 30 hours to take advantage of that. It expires tomorrow. Okay, end of the day. All right. So let's go through questions. I do apologize for running long, but we'll stay in about 5 minutes here to try to address any questions that might come up. Okay, let's see, go back. Okay, I think we tried to address some questions in the chat window for some of the founders. The founders now, the cap structure is based in the US, but can have pod office. Okay, so somebody has asking about the how to set up your equity structure. Sounds like you might be a solo founder at this point in time. Okay. I didn't get into the detail earlier, but I said even you as a solo founder should buy your stock from your own company. And the reason to do that, I said in a chat window, was for tax reasons. Um, uh, when you form the company, the right thing to do right after you form it is, if you're the sole founder, you should still buy 100% of the stock from the company. The stock value might be, you might have, I don't know, 1 million shares or something, but you're going to buy it at 1/1000th of a penny. So you write a $100 check from your personal account into the bank account of the company, and you buy 1 million shares. Okay. The reason you do that is it establishes the fair market value and the ownership start date. Okay. Um, and that ownership start date is significant because it starts the vesting cycle, and it starts the ownership clock. There are certain things that you want to be aware of because long-term capital gains will start with the ownership clock, the potential for Section 1202 qualified small business stock exclusion starts with the ownership clock. So those are reasons why you want to do it that way, and you want to buy and not grant yourself free stock, because uh, a contract is an exchange of value. If you get stock in a company, you are getting some value. What did you give in exchange? Well, you might say, well, I give my sweat equity. Okay, that's valuable. Yes, it is. But it's debatable what that value is. So let's say you and another co-founder didn't buy your stock and you just say, well, we're getting sweat equity. Well, let's say 6 months down the road, you're the CEO and you're feeling like your sweat's worth more because the other guy doesn't even work full time. You quit your job, you're working full time. Why is that guy getting, when they're sweating less than you are? Okay. And you start having some second guesses and reservations and stuff. Um, it is theoretically possible that someone might challenge the value of your sweat and challenge the validity of the contract. Theoretically possible. Understand that it would take a aggressive, innovative attorney to do that, but why expose a flank for someone to attack? If you paid cash for the equity, there is no debate about what the value of the cash is as long as the check cashed. So lots of legal reasons to buy the stock from the company when the value is low. If you didn't do that, talk to an advisor. We can't get into the specific details of your situation here on a public environment, but there are still ways to be able to figure that out. And you should talk to someone who really knows the startup space, who can give you advice on how to rectify the problems that you have now. Okay. Objectively assess and approximate the fairness of equity distribution to early and late stage employees, either senior junior starting earlier than a CTO comes in later. Okay. All right. It's a very difficult question. It's about how do you know how much stock to give? The earlier you are, the more equity you should give because the risk is higher. The more senior you are, and the hopefully that is maps to your contribution. That also is the reason why the equity is higher. There is no formula. Okay. What you can do is look at stuff that's market. Um, and there are various resources where you could potentially go to figure some of that stuff out, or you can just talk to someone who's been in the space for a long time. They can say, historically, an engineer who is at this point after this amount of funding, or a VP level person would normally get 1% or half a point or whatever the amount of equity would be. Okay. So there's not a formulaic approach, unfortunately. Okay. What do you see as the pros and cons for founders who want super voting founder shares? Impact on fundability. Okay. All right, this is an esoteric thing. Um, what Daniel's asking about is founders who want extra power. Okay, there is a variant of common stock where when you set up the common stock, you can get 10x more votes. Okay, than the average share, and that is usually done when founders are concerned about losing control of their company. It's usually done very early in the startup's life. Um, Most people who are interested in it tend to be people who are first-time founders. They heard about it. They don't want to lose control. I get the fear and stuff. The best way to not lose control is to build a fundable company. Do it the right way. And when you are negotiating for extra for investors, you have more leverage so that the investors don't get as much control or as much equity or whatever. The best way to maintain control is build fundability and get great guidance and advice. Most founders don't want to hear that. They'd rather write it into some type of early stage contract before the company has even gotten much momentum. They want to write in some super voting shares. I have not seen companies implement super voting functionality very often. It was a fad. Okay. And honestly, if you set that stuff up for yourself, you better be a very hot company. You better do really, really good job at building the company because it's a negative for an investor. If they see you have super voting rights, they're going to look like, why would I sign up for this? You better be the next Facebook. And Facebook did have super voting shares. Okay. Are you really going to grow at that stage, at that progress? If not, then why set in another hurdle for investors to clear to get a funding round? So I'm not very keen on the concept of super voting shares. It sounds good. to a rookie investor who doesn't, excuse me, to a rookie founder who doesn't have confidence that they're really going to be able to build the company, a healthy company. You can do it. Even if you do it, let's say you're marginally hot and not like the next open AI or something. Let's say you're marginally hot and you have some investors who are interested. If you get a big investor and they see that you have super voting shares, even if you have that inked in as a contract, they might ask you to waive that right before they'll sign a check. So you might have wasted all the time and money to get that in place, only to get, if you have one investor who's going to invest, the investor's going to say, no, I'm not doing that. You're going to waive that right, only to effectively cancel your right to take the investor's money. All right. So you can kind of tell I'm not a big fan of super voting shares. You you have to be an amazing startup, an amazing founder, yeah, somebody who has a fantastic reputation in the space to justify super voting shares. Okay. So there's another question who went directly, in my opinion, was the best value startup bookkeeping software to use? The most common is going to be QuickBooks, especially for international users. I've used QuickBooks for 20 plus years, both on premises and cloud versions. Um, uh, I used to love QuickBooks. Now I tolerate it. Um, there are other platforms out there. I'm not going to say version, FreshBooks or, Zero or whoever is better or whatever. There is some value in using a platform that lots of people know and understand. Lots of accountants know it, but accounting is not, it's well understood. And the only thing that's different if you go in with a different piece of software is some of the buttons might move around. Because most people know how to drive a car, most of the buttons are in the same place. The foot pedals are in the same place. When you get into a new rental car you've never driven before, you can probably figure out how to get it to move, unless you go to another country where they drive on the other side of the road. Okay. Um, so I don't know if the brand of software that you use for the bookkeeping is that significant. The cap table software is not as mature of an environment. There are other factors that I would consider, one of them being cost. Okay. All righty. Okay, it looks like that might be the last question that we see. I don't see other questions kind of coming up. Uh, Thank you for your time. Apologize for going long. I apologize that this is a difficult topic because the topic itself is complex. We didn't answer every question, and I had to skip past some details because if we went into those details, we'd be here for 4 hours. Well, if you want more time to learn some of those details, consider signing up for our training academy. That's where we'll get 20 plus hours to be able to go through content and not just, trying to shoehorn 20 hours into 1 hour worth of webinar time. Okay.
So, but if I may also, if you need help with onboarding on Akrista or help with 409A, happy to schedule a call with you. My email is tom@akrista.com.
Yeah.
Thank you.
Yeah, what I found is that Aquista is not the largest cap table software platform out there, but they definitely feel more eager to do right by the customer. Okay.
Yes.
They sometimes
Thank
say
you.
number
Thank
two
you,
works
sir.
harder than number one.
That's
Okay. All right. Thanks, everybody. I appreciate the time. Hopefully this was helpful. And do take a look at our content at fundablestartups.com and aquista.com. I think we've got hopefully some good options for you to be able to help you build your own fundable company. Good luck.